Okay, so we're going to go live on the first training. So this is like a 12-week course. We're going to keep it always to 1 hour, possibly a few extra minutes if there's questions at the end. And the aim is always to go direct to the content. So I'm not here to sell additional training or things like that. It's direct to the to the education. So it's going to be generally every Tuesday at 7 p.m. But this is the first and last one for this year. To give like the introduction, and then we'll be going into more detailed content starting the first, I think it's around the 6th or 7th of January next year. So I'm going to be doing most of the training based on my own experience and things that I've actually done myself. And there's probably 2 or 3 where I'll be inviting other people to also take part, specifically when we get to things like commercial property investments, because I haven't done pure commercial property investments myself, but I am like working with someone that is a specialist commercial surveyor and has experience in that in doing his own projects. So what are we going to be doing today? We're going to be looking at the fundamentals of property investment, getting grips on key concepts, income generation, capital appreciation, and leverage. Things like lots of people talk about cash flow, return on investment, yields. We're going to be looking in detail about what these really mean and how we're going to calculate them. And more importantly, for people that already have property, I know that some of you in the on the training today do have property. Would be good as always good to do some exercises after the training. Would be to take your own properties and look at the details. What is really the cash flow? What has been the capital appreciation? And what is the return on investment? So brief background about myself. So I'm originally, in fact, from an IT and business development background. So I had sort of my own property in different places, was doing renovations, almost like for fun or like as a matter of course. But I decided in 2018, so 6 years ago, to start actively investing in property with the aim of building up a property portfolio which could give me income to replace the income from my IT work. So I've done different things and started with basic houses, mid-terrace houses, looking at how to get the best income, so not operating them as buy-to-lets, but operating them as either small HMOs, which means houses in multiple occupations, so shared houses, or serviced accommodation, that's like Airbnb and Booking.com things. And then did things like mixed use properties where you got like shop and flat above. I've done sourcing, which is finding properties, houses for investors to buy, looked after renovation, finding ways of adding value, like converting a 2-bedroom into a 3-bedroom house or converting a house into HMO. And then I've done things a little bit bigger, like converting a disused care home into a large holiday let. And then something we will be very briefly touching on in one of the sessions is rent to serviced accommodation or rent to rent. A lot of people talk about that, and we'll be looking at what how it really works and when, if at all, it can be a good thing to do. So the aim is for everyone to get a real sort of deep understanding of property investment Housekeeping, I don't need to tell you about where the fire exits are because you probably already know that. This is for when we're doing like training with real sessions and in meeting rooms. And when we get into some of the more detailed slides, when I've gone over the main content, then feel free to like raise hand. We can see everyone here to ask a question, and we'll go into a little bit more detail. And then, yeah, we'll be finishing around 8 o'clock. So what is property investment? So the definition that I put here is it's acquiring property to be able to generate financial return through either the income. So we buy something and we've got a rental income from it. So we've got income from that investment, or we buy it. Potentially we could buy a property, leave it completely vacant, and come back to it 5 years later, see how much it's worth now. So that's what we call the capital appreciation. So in that way, we've also made money on our investment. And we're normally looking at a combination of both return through income and capital appreciation. I've got a couple of notes here. Quite a few people are buying a property to renovate it or convert it, but with the aim of selling it as soon as the conversion or the added value is done. Or people are like doing new builds, so buying a plot of land, getting planning for it, and making new houses or flats. This, in reality, is more a business than an investment, because it's actually actively doing work and adding value on things. But if, as investors, you invest in a company or someone that is doing something like that, we can still consider it to be a property investment. And then the second note that I've got on here is to get into property investment, it's not always necessary to buy a complete property. So you haven't got to go out and find, maybe you don't have the money available for that. Possible to, instead of buying a complete house, to go into partnership with other people and buy a share of a house. And in that way, you've got the share of ownership, share of the ongoing income. And as the house prices or the property prices rise, also a share in the capital appreciation. I will add a note here is when I'm talking about share of a property, I'm talking about the share of a specific property. It's true, it's something that I'm doing through a company. I'm buying properties and offering shares in that property. In this case, it's always an individual property. So when an investor is coming on board, they know what they're investing in. It's like a specific house, or maybe it's a small hotel, or maybe it's something, an HMO, but people know exactly what they're buying. Another thing that exists, do you see my mouse, by the way, as it's moving?
Yeah.
Yeah, okay, great.
Yes.
So more general property investment funds or bonds. I'm not going to be speaking much about these during the training, because these are more like financial type investments. So there are development companies that issue bonds, which are basically a financial instrument giving a return. So they have a price. They might be quoted on some open market. But these bonds or these investment funds are going to be invested in multiple different projects. So if people are investing in this type of fund, you'll understand maybe what type of projects or properties the company is investing in, but you don't have any assurance that your money is going into any specific property, and you can't do your due diligence to see that one specific property corresponds to what you want to invest in. Are there any questions maybe at this stage before I go on to the next slide?
No, good.
Good.
Good. Enough for me at the moment. Thanks.
So why invest in property? Obviously, alternative investments, the main other types of investment that we talk about are investments in stocks and shares, or investment now is quite popular and can be giving quite high returns, in fact, is crypto currency. I, just as an aside, I badly invest in shares because that's not my expertise. And I don't invest in cryptocurrency, but that's like a choice. Why to invest in property? The main reason I will give is stability, because obviously crypto can be very, very volatile. So it can go high and it can also go extremely low as well. Stocks and shares as well can fluctuate massively and can be down for a prolonged period of time. Whereas property investments generally are always increasing in value. There are occasional downturns. It might, like when 2008, property prices went down 15 or 20%, but within 2 years they were back up to the same values and growing. And then the other thing, investing in property, is, have you ever heard of someone going to the bank and saying, I'm planning on buying £10,000 worth of shares. Mr. Bank Manager, could you please lend me £77,000 to buy these shares? It doesn't happen because there's no security. But when you're buying a property, you can go to the bank. Obviously, if the property that you're buying is a good security for the bank to lend against, then you can borrow money, and we call that leverage. So you're able to use the bank's money, basically other people's money. Obviously, you need to be careful about how you're doing that. And property is basically the only investment where you're able to use real leverage. I mean, I've got a couple of real examples, examples later on to show that. So those are some of the reasons of why you invest in property. Maybe someone's got another reason as to why to invest in property, or maybe a reason not to invest in property. Maybe someone would like to add something.
Well, like you said yourself, it is a good investment for the future. With properties, money, it's very rare people lose a lot of money unless the deals go bad.
That's right, yes.
Yeah.
Yeah. Yeah, it's like things to ensure that there's to not, like if you're using bank lending, to not borrow too much. So that if prices do temporarily go down, there's no risk to the basically, or to the lending, to the bank coming and saying, I want the house back, for example. Yeah, and also to ensure that there's enough like backup income to pay for mortgages and ongoing charges if there's a temporary loss of income in property. Okay, so let's move on.
Yeah, sorry, Troy. I was going to say, I mean,
Yeah.
just to add to it as well, apart from it being stable and traditionally knowing that property is always going on the app, is it's not abstract. It's actually physical. You can see what you own rather than other things like bonds and crypto. Is all virtual, isn't it? So
That's right, yes.
so there's that element of knowing, okay, this is what I've invested into, so I've bought into. You can physically see it. So maybe
That's right, yeah.
Appeal to people to buy into things
Yeah,
that
you can physically see it, and it's not difficult to understand what a title document is.
Yep.
That shows that you own a property. And in reality, when it's like a shared investment in a specific property, there's an additional layer on it because you've got the limited company that owns the property, and then people that own shares in that limited company. But that also is possible to go onto Companies House, see who owns the shares once they've been registered.
Mm.
And it's yeah, you know exactly what property it is. Yeah, whereas effectively it becomes more complicated and yeah, not so easy to understand and comprehend unless obviously you work in the city. Yeah, what for example, there's a type of fund called an REIT, which is real estate investment trust. And there are different funds, there's different laws that govern how all these things work, but it's a lot more complicated. And that's in reality is more people that are into stocks and shares and can understand that sort of thing. And that's why I put my like dividing line between shared property through like a limited company and then things which are funds or trusts investing in different types of property.
And maybe can I just add as well? So these days, you know, retirement pensions is not enough to survive. Just relying on that, but investing in property, for example, when you reach retirement age, could be additional source of income, and also you can also pass on generational wealth to your children and grandchildren as well. That's one of the benefits of investing in property.
Yeah, absolutely, yes. And there are ways, we're not touching on those during the training, but there are things like, yeah, ways of reducing the taxes when transmitting to, children, for example, things like trusts and well, different schemes.
So,
Yeah, so let's move on to key investment goals. So we've already mentioned this, and I'm going to explain this again. So income generation. So when we have a property, as long as we've got tenants in there, then we've got regular cash flow. So we've got regular money coming in from the rental properties. The term cash flow here is used maybe a little bit in a free sense, because in a moment we'll see that cash flow, we have a specific meaning for that, and we can have positive and negative cash flow. And one thing also about income generation, there's a question also of de-risking this sort of thing. So if, for example, you got one buy-to-let house that you're renting out to a family, then if that family, for whatever reason, stops paying, then your income stream is completely stopped. So there, the risk and the way of like alleviating that risk is potentially to take out landlord insurance. If, however, you got, for example, 4 houses, let's say you got 4 houses and they're all 4-bedroom houses that you're renting out on a room-by-room basis as HMOs, you've got 16 rooms. So if you've got 1 or 2 people that stop paying, or you've got voids, you've still got 7/8 of the income coming in. So there you're like de-risking it in that way. That's like just as an aside. So we've got the income generation. We've got capital appreciation. So we buy something and then typically house prices have doubled every 10 years. I'm not going to go into detailed statistics, but even if we take it very conservatively, we can be almost sure that within 10 years, capital value will have increased by 50% on what we bought like 10 years ago. So that is the goal when we're buying something, to have a reasonably, obviously we don't have a crystal ball, but to have a based on like past tendencies, to have a good idea that we're at least in an area where we've got a good expectation for capital appreciation. When we come back to the income generation side, obviously if it's a very high prices for getting into property for similar rental yields, then our income isn't going to be so great, which is why even people in London, such as myself, we're often investing in low-cost areas. As I think some of you know, I invest in South Wales, also in around the London area. And yeah, that's one of the factors that comes into play. And then the other key factor in investment goals is using leverage to amplify, to increase the returns on the money that we put in. Because when we're going to be talking about return on investment, it's the return on the money that we put in. And if the bank is putting money into there as well, as long as the return on that investment is at a higher rate than the amount that we're paying to the bank, then it's good to be able to use leverage. So now we're going into some more specifics with examples. Return on investment is the amount of money that we put into a specific deal. So in this example that I'm giving here, we're not using any leverage. So let's say we've got in our back pocket £100,000. So we buy a house that's ready to go. It's like ready to let out straight away. We haven't got to do any renovation. And we can rent that out and get 5,000. This is not a good deal, by the way. We get 5,000 annual net return. Net return means the money that we get after we paid the expenses, which might be insurance, it might be management fees to a letting agent. That is the return on the money that we put into the deal. If we've used lending and we've only put, for example, 30,000 or 40,000 of our own money in, obviously the income is going to be less because you've got a mortgage to pay to the bank. But then the return on investment will be the money that we put in and the money that we get from it. And we'll see some specific examples of that. Because the next slide I think that we're going on to is yield. In this calculation, yield is the same as return on investment if we buy a property entirely with cash and not using bank lending. Because yield is a metric that's used a lot by lenders. It's used by, estate agents. Yield is the rental income divided by the property value as a percentage. So in this example, if we've got a income of 12,000 and the value of the property, so that doesn't mean to say the money that we put in. It might be that we put in 30% of that and the bank lent on that. That doesn't affect the yield. The yield is based on the property value and generally the expected rental income. And there are statistics for all the different areas in the UK, which gives the average rental yield of properties. And as investors, we use these figures to determine where are perhaps good areas to invest, but we're also going to be looking at capital appreciation. An important thing, however, to bear in mind when we're talking about yield, almost always when an estate agent is talking about yield, they're going to be talking about gross yield. So in this example, we've got a property that has got a value of 200,000. £12,000, typically if we're talking about a gross yield, that's the amount of money that the tenant is going to be paying per year to rent that property. So it's the money that is basically the house, in inverted commas, is getting, but it's not taking into account the expenses. When we take off the management fee, if you've got a management agent looking after, or an estate agent looking after the property, that could be 10%, 12%, possibly 15% if it's an HMO. Then we've got things like insurance, we have to take into account potential voids. And after all those calculations, then we're going to have the net yield. And especially if we're doing things like HMOs, the net yield is a lot more important than the gross yield, because we might have an HMO that's got, for example, double the income, 24,000 instead of 12,000. But when we've taken off our utility bills every month, paying maybe a cleaner to go in every month to clean the common areas and things like that, the net yield is going to be higher than renting out probably as a buy-to-let, but it's not going to be necessarily spectacularly higher. So that's important to bear that in mind. So yields are based on property value. So let's say, for example, you did buy that property at 200,000. Let's say in 10 years' time, this property is worth 400,000, and the rental income also is like double. The yield is still going to be 6%. But if you'd bought that property with 200,000, your annual return on investment is now going to be 12%, because the return on investment is always based on the actual physical amount of money that you put into an investment. And then if I go on to the next one. So I just got, is there any questions on return on investment or on yield?
Yeah, I was going to ask quickly, Trevor. So when it comes to expenses, I know this obviously is the 12,000 there in that example is what you're getting out of the property, or what the property is giving you without expenses being deducted. When you think about void and insurance, do you, I mean, if you're getting insurance for potentially just to make sure you don't to cover yourself from rental void, do you still need to consider void, or is it dependent on the insurance you get?
In fact, in reality, when I said insurance, I was thinking about the standard landlord insurance to cover the building and responsibility. And so in that case, you still consider the voids. If, however, you're having landlord insurance, insurance to cover voids, then you wouldn't take into account the voids.
Okay.
Or you'd do a risk assessment. You'd think, are there any possible potential cases that this insurance doesn't cover? And you might still have some small factor involved in it, because maybe the insurance might say if someone ends their tenancy, because in fact these insurance are more to cover a tenant who stopped paying. They're not actually covering voids, in fact. So you would still need to include the voids or the potential voids in your calculation of net of the net income. And this can also depend on the area, because if it's an area where it's typically families renting where the children are going to a local school, you're likely to have fewer voids because the people may be staying in there for 5, 6, 7, or even more years. Where if it's an area for young professionals who are going to be potentially moving around or upscaling or moving in with partner, for example, then you might be considering that you've got an average tenancy of 1 to 2 years. Therefore the voids are going to be higher. Any other questions on this? Okay,
sorry,
Yeah.
I have a question. I was talking on mute. So I know that when you're buying a property, you obviously look at the two, the yield and the return on investment. Is that one that you prefer over the other, or which one do you is really important to you when you're
The
looking
most important is actually the return on investment.
Okay.
Yeah. The reason I'll be looking at yields if, for example, someone says to me, I'm thinking of buying a house in, I don't know, in Leeds, for example. I would have a quick look and I'd see that maybe yields in Leeds are maybe like 5%. Whereas if they go to, for example, I don't know, Bradford, it's maybe 8% because house prices are cheaper. I might say, well, have you considered Bradford sort of thing? If, however, I've decided I want to invest in, let's say I've decided I want to invest in Bradford,
Yep.
then I'm going to be looking more at return on investment. I'm going to be
Right.
thinking, this is the amount of money I'm going to be putting into it. This is
Yeah.
what I'm going to be getting, and this is my return on investment. So as
Right.
soon as I start getting into more details about what I'm going to be using my money for, it's return
Yeah.
on investment.
Right.
The
Okay.
yield is more like for homing in, or also if I've got an investment somewhere, I'm
Yeah.
going to see what yield I've got. I'm going to look at what are the average yields in that area, and I'm saying, gosh, I need to increase my rents or something's wrong. Or I might be thinking I'm doing quite well. Could be either way.
Right. Okay.
Right, let's move on. Cash flow. So cash flow is generally very important, especially if you're because also, yeah, well, one person mentioned investing for retirement, which is a good plan. When you're investing for retirement is maybe a little less if you still have a full-time job. It might be a little bit less important, the cash flow, and you might be looking more at where we're going to get the capital appreciation. If, however, the goal is to get into property to replace work income with property income, then we're going to be paying very, very close attention to the cash flow. So to come to my example, when I started, my objective was to get money for basically for money for living. And I was therefore paying a lot of attention to cash flow and paying a lot of attention to how I'm using the operating the properties that I have to get maximum cash flow. So cash flow is basically the rental income minus the expenses. So the expenses are mortgage, taxes, utilities if we're operating an HMO or serviced accommodation. And then if we serviced accommodation, we've got like management fees, cleaning fees, guest supplies, and all sorts of different things. So at the end of the day, the cash flow is the net money coming in every month. So it's not necessarily related to the return on investment. It's actually how much money is, because basically that money you've already put in there, it's sort of locked in the property. The return on investment, you're going to be thinking, if my return on investment isn't great, then maybe I'll take it out, sell, and do something else. But cash flow here is, yeah, how much money am I making to be able to spend or to be able to invest in something else. So we're always in reality looking for positive cash flow. I can't really see any case where we'd accept like negative cash flow unless it's for a period where we're obviously doing renovation on a work and we've got no income for those months, then we're going to be on negative cash flow. But then that's planned and it's part of the overall plan for the investment. So those are the main things. Yield, return on investment, and cash flow. And it's important like to come back to what these really mean, because especially in some of like the larger like property investment circles and some of these groups that are all selling their courses. Obviously, I sold my course, but hopefully it's direct useful information. People will say, what's the cash flow? Where in reality they mean what's the return on investment or what's the yield. Try and always have in mind if you have properties to actually know this is my cash flow on each property, this is my return on investment, this is the yield in the area that I operate, I'm getting this yield. It seems okay, sort of thing. On to the so we're going to in a moment come back to an example of yields and leverage. This is the overview of what's going to be happening over the next 11 weeks after the break. So we're going to be doing the most standard strategy that people use, which is buying a house, renovating it, renting it out, hopefully having added sufficient value to be able to refinance and get the money out. We're going to be covering rent to rent and rent to serviced accommodation, and seeing what can be the advantages, disadvantages. This one, buy to let income streams. So let's say we bought a house, we renovated it. We're going to decide what we're going to do with it. Are we going to rent it out as a standard buy to let? Are we going to operate it as an HMO? Are we going to do serviced accommodation? Are we going to do one of the in things these days, which is social housing, rent it out to a social housing provider? So we're going to be looking at these. Week 5, what's the joint venture? Week 6, purchase lease options, which is a way of getting control of a property with an option to purchase it later. So it requires a smaller amount of money at the beginning. More specifics on HMOs. Title splitting. Oops, sorry, I went back. Title splitting, which is buying a property, for example, converting it into flats and putting them on separate titles, to be able to add value. We'll be talking about planning permission, what things we can do, what things we can't do, adding value using planning permission. Commercial to residential conversions we'll be speaking about. And then pure commercial property investments. There's quite a lot of scope in this, including some creative strategies, and then the recap. Going on to a real example. So I'm going to illustrate what leverage is. I'm going to change the share to a Excel file that I prepared a little earlier. Just a second. Share. Right, so we've got the so this is an example of someone who's got £100,000 to spend. So we're not talking about the value of a house, we're talking about someone who's got £100,000 to put into property. So we can decide that we don't like banks and we're going to buy outright a property and own it, rent it out, and see how things go. So what happens, we've got, I've taken a simple example where we've got £10,000 net income. So after we paid the bills on this property, probably to get 10%, we're doing an HMO. But anyway, it's just an example. So we've got a return on the money that we put in. So we put 100,000 in, we get 10,000 per year. So return on investment is annual return on investment. So we're at 10%. And assuming that the value of that property is going to increase by 50% over 10 years, 10 years later, we'll have had our 10 times 10% ROI, and our property value will have increased by £50,000. So we've got inflation as well. So we have to consider what inflation was, but we've got £50,000 more. If, however, that same £100,000, we go to the bank and borrow £200,000, which corresponds to approximately what we're able to do when we've taken into account like legal fees and stuff like that. Instead of buying one house at £100,000, we can buy 3 houses. It's a bit like Monopoly. So we've got 3 houses. So now we've got 3 rents coming in. So we've got £30,000 coming in. We do, however, have a mortgage, so we have to pay every month £12,000 to the bank. That's based on 6%. But so we've got now got an annual net income of 18,000. So instead of 10%, we've got 18% return on investment. So that's showing the real advantage of leverage. But the more amazing thing is when we look at this line, the capital appreciation, over 10 years, we've gained £50,000, 150,000, and we haven't had to borrow any more money from the bank. So 10 years later, because typically these are interest-only mortgages, 10 years later, we've still got our mortgage of £200,000. We've got higher rental income, and our property, and we've gained £150,000 in value of property. So even if mortgage rates were to go up to 10%, 10% is our income. So if our mortgage rate is at 10%, you could say to me, what's the point in having a mortgage? Because the existing mortgage cost is eating 2 of the rental income. That is true. However, in 10 years' time, we've got 150,000 of additional profit from the increase in property prices. Most likely our interest won't have been at 10% all that time, and the mortgage is still 200,000. So obviously it's a risk if we're here because our income is lower. But until we get, if I increase it to 15% interest rates, which is horrendous, we're still 0 cash flow, and we've still got our capital appreciation. And if interest rates are going to be at 15%, then most likely after 10 years, we're going to be probably more like 100% increase in the property price. So at the end of the day, it's still a good deal to use that leverage. And obviously it's possible to do, this is obviously a very basic Excel file. We have much more complicated, complete ones which take into account all the costs, and we'll see that when we look at the buy, renovate and refurb next month. We'll see examples of how these things are calculated. And if anyone wants these Excel files, I'll be happy to share them.
So Trevor, in this example, would you say that obviously time is a key factor here in terms of looking at how leverage is playing a, it's basically helping, the investor look at the return on, I suppose, appreciation in 10 years time. But if you were to look at a shorter term, I suppose the question is I'm sure that potentially is a scenario where without having leverage, if you have the capital to basically go in and invest in the short term, potentially might be beneficial rather than looking at leverage.
Well,
Is there
yes,
any
because
other
even if
scenario
you
where
go, sorry, I interrupted you. Maybe you was going to finish.
No, I'm just saying, is there any scenario where potentially you don't, the first option of you just using your own, money to obviously run the entire project, it's beneficial if you from your experience, really, do you see any scenario where you think through a deal and you think, oh, actually, maybe without the banks, I can actually still do this and it's going to be profitable in the short term?
Yes, I mean, even like, for example, if the return on investment is going to be 10%, it's already much higher than what you get if you leave it in the bank. And also, if you're investing, if you had that 100,000 and you bought a complete house, you could, especially if you, and we'll see this next time, if we're doing buy, renovate and rent out, then you can consider refinancing when you finished it, or you can, if you see that interest rates are still high and it's a bit of a risk, then leave it for a while. But then if interest rates are going down, you could think, gosh, I can get all my money out and do the same thing again. And then it's worth doing it. So I would say, yeah, definitely to be able to do things without using the leverage, but still have in mind the possibility of, if the time is right, to use that leverage to do something else, or get money out, or to generally increase the return on investment.
Okay.
So I'm going to go back to the slide. So we've seen the example, and I think we're almost at the end. Yeah, so wrap up and self-study. We don't like calling it homework. And it's obviously completely up to you whether you want to do this or not. Yeah, so the key takeaways, we've spoken about income, capital appreciation, and leverage. And recommendations for self-study. If you have properties, get a grip, sort of calculate the yield, return on investment, see what capital appreciation you've had since purchase. Even if it's just going on to Zoopla and doing a simple put your specific property in and see what value it comes up with. It'll give you an idea. And if you've used a bank loan to get the property, as an example, see what it would have been like if you'd use that money maybe to buy something less expensive, and to see how leverage helped you on that specific deal. And if you don't have properties, then maybe go on to Rightmove, maybe in your area. Look at an example, take an example where you can see property prices, and you can also look at rental prices in the area and make a few calculations. Imagine that you're going to be buying that property as a cash purchase, or using a mortgage, and try and get a handle on the figures.
You would do this kind of stuff though before you go to view a property. You do your homework, wouldn't you, on the spreadsheet? Because really, you're not going to go and look at a property if it's not going to give you any profit in the long run. That's what I've been taught with Carl. Like, we
Yeah.
keep the figures in, then you put your stamp duty, and obviously going by the mortgage principle.
Yeah.
You would definitely know by the end.
Generally, I do that, yes.
Yeah.
One thing that we do is I'll give if I can find it, a fast preview of this. Just one moment.
Because for Wales, majority of the properties on a buy-to-let, there was too much money left in the deal, so it's just not worth it.
No. So generally, sometimes I go and see a property on feeling because I've got like an idea that it's likely to be good. And also one thing that we haven't touched on, and I probably need to add, well, it will be like in purchase lease options, but there are other creative deals. When even if a property maybe doesn't have the great yield straight away, if there's some creative deal where for example, you need some renovation, and there's a possibility that the owner would be prepared to let you take over the property and have his share of a profit share rather than buying it, then it's like worth exploring. So sometimes, effectively, I'll go and see a property on feeling. If, however, it's a question of like specifically going somewhere to, I'll do some calculations beforehand. What I'm going to show you is,
You know, with these properties, like with purchase lease option, or am I saying it correct? I might be saying it wrong.
everyone calls them purchase lease option. They're two separate agreements. It's a lease with option to purchase, and there's two agreements that sit side by side.
Okay. So really, in reality, is how you would put those questions across to the vendor Do you see what I mean?
That's right, yes.
I mean,
And you don't put those questions across to the vendor generally on the first meeting.
no, you wouldn't.
You're not going into a vendor and say, hello, nice to see
No.
you. Would you like to give me your profit
No, he's
property
gonna close
for
the door.
free? You haven't met me before. I'll give you a profit share at the end.
No.
And then they're going to say, yeah, of course, I'll be glad to do that. Where do I need to sign?
No. I gather that, but are you going to be covering that kind of training as well, you know, of how to...
Probably not in these first 12 weeks, but
No, no. All
there'll be
right,
other ones
okay. That's
going
all right.
forward. And yeah. What I am showing on the screen here is, just to give you a bit of an overview, there were one of the main auction houses called Paul Fosh. We're doing, I think there's about 70 or 80 houses up for auction in South Wales.
Wow.
One of the things that we do is we pre-qualify potential auction purchases for investors. So if someone says to me, look, I'm interested in getting a house in South Wales, especially because on auction you can get the house within 28 days. So what we do is we go through the catalogue, we have a look at things that might be potentially of interest, and then we break them down. Like here, we can say things like when are the viewings, what's the address, surface areas, and then we've got our different calculations. We see what the guide price is, what the estimated reserve is. And then based on all these calculations here, like stamp duty, sourcing, legals, and all that stuff, we end up with a maximum purchase price at which we're prepared to buy the property.
Yeah.
And when we've got that, then we're going to say it's worth going to view it. If we've viewed it and someone's interested in potentially buying it, then we'll go into a second level of detail and understand a lot more. And we'll do stuff like looking at legal packs and seeing what the conditions are. And obviously, at the end of the day, if it's for an investor, the investor will want to look himself and potentially consult their own solicitor before going forward. But yeah, we are doing that level of looking at things before going to do viewings.
Okay.
So we've got 1 minute left, or we can add a few more if there are any questions. Any remaining questions?
I like you mentioned just generally the average rental yield in London is not quite attractive given obviously higher mortgage rates and things like that.
Yes.
So what are some of the things that would make a deal attractive in London?
What I find attractive for a deal in London, it's where we can buy something, add a lot of value. So for example, and this will be like covered next week. So let's say we're buying a house, like a large terraced house. We're looking at one, for example, in Battersea. Purchase price is likely to be around £1 million. We could spend probably maybe 200,000 or 300,000 on it to convert it into, let's say, an 8-bedroom HMO. And when we've done that, we can probably end up with a commercial valuation of, let's say, for example, 1.8 million. We go to, we go to the bank and we get refinance at 70% loan to value, and we've got all our money out. And then we've got an asset which has got some positive cash flow. Obviously, we've got the mortgage on it, is capital appreciating, and we've got our money out to go and do something else. If we're doing things in high yield areas, it's not so much of an issue to leave some of the money in. So London, we like to, I mean, obviously I'm speaking for myself, but like to do things where there's a good possible to get the money out.
Yeah.
And also creative things. So it can be also, it could be a landlord that's got HMOs, for example. It could be someone, landlord who's understands all these these renters reform bills and all this sort of stuff, which is making it a lot more frightening, a lot more legislation, and wants to get out and say, but doesn't need the money straight away, so can agree to some creative deal where maybe it's a progressive purchase. Maybe that purchase also, because it's progressive, can help him on his capital gains tax bill, things like that. So those are sort of things that we're looking at everywhere, but we're in London more focusing on that.
Okay.
Because standard buy to let, apart from the capital appreciation, which is good, and yeah, like sort of retirement, if the aim is to get a good return on investment, then there's yeah, better things to do, sort of thing.
Yeah. Okay.
Okay, so we're going to wrap up there. If you found it useful, maybe if you have friends or contacts that would be interested in taking part, yeah, please introduce them. And I'll be sending out probably tomorrow the link to the recording, so you can look at these. And a few other people did subscribe to the training. They'll have access also to these same recordings.
Thank you.
Well, thank you for your time, and
Thanks,
yeah,
Trevor.
have a good evening, everyone.
Thank you. Yeah,
Bye.
thank you, you too.
Bye.